All right, welcome, Mauricio, to the show, brother.
Thanks for having me, man. Really appreciate it.
Well, third time's the charm. On our last video that we did, our last podcast, the audio was fine, so it was a great podcast, but we screwed up on the video. So I made sure that we've got the video on, and so if you like to watch video, because we're gonna try to talk about something complicated, you may need to see our hand gestures. You definitely need to see our pretty faces. So head on over to my YouTube channel at Corey Peterson on YouTube, and you'll find this podcast. So, all right, man. So we're going to talk today about something I think more and more people are very curious about because of COVID-19 is protecting your assets.
That's right.
Asset protection, and that's something that you do. A lot of people don't know you do, but you do a lot of it. And probably, I would say you're probably ramping up more, right?
Yeah, so I'm an asset protection attorney. I just haven't been doing it for the general public. I stopped doing it like 5 or 6 years ago. But for my syndication clients, I offer my asset protection review and make sure everything's set up properly and all the other assets are well protected. But man, I tell you, the two most common themes now with this whole COVID thing are number one, people wanting to put together funds, kind of opportunity funds to go out and acquire some stuff. And then asset protection. That's another call. Beginning, a lot of people wanted me to take a look at their structures, and inevitably they're all wrong. So we try and fix them.
Well, yeah, because think about this. It's really, everything's fine when everything's right. That seems to be how everything is until something goes wrong.
That's
Right now, anybody that, listen, the whole world, the whole country is hurting. Everybody's feeling it, up to the lenders, everybody. But it's going to be like some people are going to fare out a little bit better than others if it does go bad. And those are the ones that have pre-sheltered their assets in the right way. So let's talk a little bit more. Like, what does that mean? What does asset protection really mean? Where do we start with it?
Look, it basically means that you are trying to. There's really two. Let's do this. That's hard to do without a diagram. So let's try and articulate this properly. So
Mauricio doesn't have a whiteboard right now.
I'm on my flip chart, which is challenging. But look, when you talk asset protection, there's two different specific things or different angles that you need to look at, and they're completely different. Most people think of one and forget the other, but asset protection means protecting you from your assets and also protecting your assets from you. And those are two complete things, because most people think of, let's say real estate, and they have an asset and they want to make sure that if something happens, there's a slip and fall or a fire or something horrible, they want to make sure they can't get to their personal assets. So they're trying to protect themselves from the asset. What most people forget is they themselves are these huge liability producing entities, people. You're out and about all the time and you're creating liability. You're in a car, you can get into a car accident, you're engaging in business. You're a big liability concern. And so the other angle is, what happens if you get sued? Forget about the assets, but you get sued, and now somebody has a judgment against you and wants to go.
Oh yeah, they look at you and say, "Oh, he's got money."
That's right. And as you know, Corey, it's not a question. Unfortunately, it's not a question of if you're going to get sued at some point. It's when. And there's so many statistics, especially if you're a business owner. I think like 1 in 4 business owners get sued, and most of them are frivolous. And yes, you should have insurance. Insurance is always your first line of defense. But man, when times are tough, that's a lot of times when people come out of the woodwork and try.
You see the worst in everybody.
Yeah.
Everybody. Yeah, I totally agree. So, what's the correct way to structure? Let's use the property analogy. And, how do you like to structure people that are doing syndications in real estate? Like, what does that look like?
Yeah. So I always like to draw a line. I mean, the goal of asset protection is to build that barrier between you, the individual, and you, your assets, right? And so the way we let's take real estate, because there's all kinds of assets, right? Business, stocks, precious metals, whatever. But real estate, that's what we primarily love. So if you're trying to protect you from your property, meaning you're afraid that somebody slips and falls, or the boiler explodes, or there's a fire, or something horrible happens, remember, under U.S. law, the owner of the property is legally responsible no matter what. If somebody slips and falls on your property, you can't say, oh, I didn't know, or, it wasn't my fault. Like, you are basically strictly liable for that. So the key is to make sure you don't own the property. It's that simple. So what we typically do is we put that property inside an entity, right? So that the owner of the property is no longer you individually, the owner is an entity. And for a variety of reasons, the most popular entity that real estate investors specifically use is the LLC, the Limited Liability Company. And what that does is exactly what it says. It limits your liability. It limits your exposure to what's inside that LLC, which is what? Your property. So
Right.
equity in your property is fair game. And then anything else it owns, which most likely might be a bank account with some cash in it. And that's probably it. Equity in your home and cash in the bank. That's what it protects you. So if somebody slips and falls, who's responsible? The LLC. Great, I have a judgment against the LLC. Now I have to go part two, which is I've got to collect on that judgment. And I say, okay, well, what does the LLC own? I want to go after its asset. And you say, well, it obviously owns the house. So help yourself with the equity if there is any. And it's got a couple bucks in a bank account, go there. Ideally, you also have an insurance policy within that LLC. But that's what handles the property being exposed and trying to protect you from your asset. Okay.
So if you magnify that, say, okay, you have, we'll call it apartments, right? But you have multiple apartments, okay? And that's where you're saying, okay, so the slip and falls on one apartment that's owned by an LLC, all your other apartments are owned by LLCs, and so hence they're probably not affected by the slip and fall in one.
That's exactly right. And so apartments are easier to think about, but single family homes, some people want to put 3, 4, 5, 10, 20 properties in the same LLC. You just got to realize that if the LLC gets sued because something happened in property number 1, remember all of the assets inside that LLC are exposed. So now property 2, 3, 4, 5 through 20 are also exposed. So
that's a great point. It's a great point.
The way to mitigate that, and that's why you see people setting up separate LLCs and putting separate
or series LLCs.
Series LLC is a whole podcast, Corey, that we could probably do for an hour on that because they're those are relatively new things. But in theory, yes. In theory, you could have a series LLC and have a property in each of those series. It supposedly acts the same as multiple LLCs. But that's the idea. And so when you're structuring, you start asking questions. Well, how many single family homes, if that's your business, how many of those can I put in one LLC? Because let's face it, from a financial standpoint, if you have 20 rentals, single family homes, putting them each in their own, they all have costs and setup costs and maintenance costs.
Yeah,
it doesn't make sense. So
it's not always the best bang for the buck.
How many
Sometimes
you put into an LLC, that's up for debate. That's something that I help people with. But an apartment building, I mean, if it's a 100-unit apartment building, and certainly if you're syndicating it, because if you're syndicating it, that means the LLC itself has multiple owners, and they're going to be different owners from different properties. So just from a regulatory standpoint, you're going to want to have a separate LLC. But if you were a big wig and you own 3 apartment complexes, you would be smart to have each of those apartment buildings in their own LLCs so that you no longer own them. They're owned by an LLC, and the LLC is responsible, not you.
Okay. Now, where do you like to register, and does it matter where you register an LLC?
It does matter, but that's where the analysis of which angle we're looking at comes into play. So in the scenario we just talked about, we're talking about, again, protecting you from your assets. So you're going to create the LLC, put the property. We typically create those in the location where the property is located, because I don't care where you set it up. If your property is in Texas and somebody slips and falls in your property, Texas law is going to govern. I don't care if you set it up in Delaware or Nevada and then registered it back. At the end of the day, local law is going to apply. So there's no real benefit, in my opinion, to setting it up. Maybe a privacy argument could be made, but setting it up in a different state, you still would have to register it back in that particular state, and so you kind of lose whatever benefits are. So from a protecting yourself from your assets, it's going to be where the property is located. Let's look at the flip side, the other, which in my mind is more important.
Okay.
And let's say, how do you protect your assets from you? What happens if somebody sues Corey personally and gets a judgment against Corey? Well, if you just have an LLC, then great, you don't own the property, but you own an LLC, right? Or you own a corporation, so you own the shares of the corporation. So if I have a judgment against Corey, why can't I just go to the judge and say, hey, judge, Corey owns 100% of this LLC. Give me the shares of that company, or give me the membership units in that LLC because it's valuable. And I would get them the shares, and then I control the LLC. And if I wanted to sell the property, I can sell the property. That's why charging order is the key term you want to look at and research and find out. But charging order protection is what you're looking for. You're looking for a state where the judge is not going to say, oh, yeah, Corey owns this company. Here are the shares of the company. They're yours because he owes you a bunch of money, and we're going to give you the shares of the company to satisfy the judgment. They're going to say something different. They're going to say, I know you want the corporation. I know you want to liquidate the assets, but I'm not going to give it to you. What I'm going to limit you to, what I'm going to give you is a charging order, which only allows you to receive whatever monies Corey was going to receive. We'll divert those and give them to you because he owes you money. So if the corporation was going to pay you a dividend or an LLC was going to give you a payment of $100, well, that payment will now go to the creditor, but they will not gain control of your entity, and they will not gain ownership of your entity. They simply have a charging order, which is not the ideal thing for a creditor. That's not what they're looking for. They want to have the shares of the company. They don't want to have a court order.
Right, because they probably want to liquidate it immediately. Yes.
Yeah. So that's what, and that's where you want to be in a really good asset protection state that not only recognizes charging order, but limits you to only a charging order, where the exclusive remedy is a charging order. You want to be in one of those states to make sure that if somebody goes to a judge and asks for the company, the judge will say, not so fast, my friend. You can't get the company. I'm just going to give you a charging order.
So what states typically do that?
About half of them actually have charging order protection as the exclusive remedy. The states that I like the most, there's 3 of them. And the reason I like these 3 is because most of us are, closed companies. It's Corey, you own a business, I own a business, the client owns a business. So they typically have their own LLC and it's just them. They're what's called a single member. Most of you out there will ultimately have a single member LLC, or maybe if you have a spouse, it'll be a husband and wife LLC, but essentially it's a single member. And in a single member scenario, the charging order isn't as strong. It's a long story, but just trust me when I say that the reason we have charging orders doesn't make sense when it's a single member. And so there's only 3 states that have gone out and amended, changed their rules, their statutes, to extend that protection to single member LLCs. And those states are Nevada, Wyoming, and Delaware, which is why you see and hear about those 3 states. And anytime I create an LLC where my client's the sole member or along with their spouse is the sole member, then I like to set those up in one of those 3 states. My personal favorite is Wyoming, but I wouldn't criticize anybody if they said they wanted to set it up in Nevada or, and certainly if they live in one of those states.
Well, so like think about, and I'll just know this, like Wyoming is, they like electronics. Like you can log in, through the computer. Delaware is a little bit more tricky in setting up from their state. It's just not as easy per se, I think. So I found that Wyoming is a lot easier to register your LLCs and get all that stuff done.
One of the things I love, and the reason I love Wyoming, is that if you're into privacy at all, which I think you should think about, you don't want to have a big target on your back, and a lot of times that's the first thing a plaintiff's lawyer. By the way, I used to work for a plaintiff's lawyer after I graduated college, before I went to law school. But the first thing a plaintiff's lawyer does an asset search.
Yeah.
Right? And so they're going to look for all the stuff they can find, because they all work on contingency, right? So they're only going to get paid if you get paid. So if you end up having a lawyer take a look at it and they have a slam dunk case, I'm like, man, this is a clear cut case, it's a rear ender, they broke your neck or whatever, but I can't find any assets. Do you think the lawyer is going to want to spend the next 2 to 3 years of his life or her life getting a judgment for you, going through the whole process of a jury and the whole thing, and not know whether he or she can collect on that judgment? I don't think so. And so typically, if they don't find assets, that's when they're, they like to settle, or if there's an insurance policy, they'll take the limits. So privacy is important. And what I love about Wyoming is that the state of Wyoming itself has no idea who you are. They don't require you naming the owners or the managers on the formation documents. They don't require that information on the annual renewals. So if you go on their website looking for this particular company, the owners won't show up, the managers won't show up, you won't show up anywhere. And even if somebody flew to Wyoming and went physically into the office of the Secretary of State and asked for the I guess their boxes with the files, they wouldn't know who you are. So that's why I love Wyoming. Now they can get it. If there's a lawsuit or whatever, the registered agent actually is required to keep that information. But it's really difficult for somebody looking and scooping around to find out who owns stuff in Wyoming, which is why I think it's pretty powerful to have at least part of your structure in Wyoming.
Right. No, that's actually really good information because, in a digital world, privacy is more important than ever. And listen, the thing about targets in your back, I have an education company. You're listening to my podcast. We talk about what we do a lot, and so I always feel like, man, I've got this huge target on my back. And it just makes me think twice about everything I do. And so asset protection now is becoming more and more prevalent. Obviously, you're my, and just so you know, if you're new to my podcast, this is the first one you're listening to. Mauricio does more than just asset protection. He is my SEC lawyer when it comes to filing securities and creating private placement memorandums. So not only does he do that, he helps set up my LLCs, my operating agreements. Really, he really does a phenomenal job in setting all that stuff up. I just want to make sure I position you correctly, Mauricio.
I appreciate that.
And I also consider you a really good friend. So likewise. The great thing is, this is what I love about this business. When you do it long enough and you stay consistent and you do what you say you're going to do and you treat people right, friendships and long-term friendships happen out of it. And we just do good, clean business. And I couldn't think of a better way to do it, and then to have people that like, and trust. And then we talk about what do you do for fun? And you have a couple kids, and you're going through life, and everybody's at different stages, and it's fun to see that growth happen. And I think that's magic, by the way.
Yeah, it's awesome. And my old gig back in the old days, I used to be a defense attorney. So my world was very confrontational with the other side, and it wasn't a good feeling. Now it's nice because the two of us here, we are aligned, right? We're both going in the same direction. We both want to close on this property. We both want you to raise this money, and it's just such a much nicer existence. So it's a great business to be in when you can form those relationships and have everybody as part of your team.
Yeah, amen. So I've got a couple. We actually knew that you were coming in, so I surveyed a couple of my students and just seeing if they had any attorney SEC kind of asset protection questions. And so I'm going to set up this next question and just have you give your opinion on it and from your point of view. So we're talking about corporate structure. So she's like, I have an S corp in California that I will do my marketing through. And basically what she's saying is we'll call it a management company, right? It's a management company. And it's typically how we structure. She understands how our setup is. Typically we have a property LLC. We'll call it property LLC. It's what creates our PPM. Then we have A shares and B shares. A shares are usually your investor shares. B shares are your controlling shares of the property LLC. And usually in that document, in the B shares, we'll normally elect a manager of for us, it's Kahuna Management LLC. And so she's saying she's got a management company that is a S Corp. And she's saying that she wants to make her B shares, right, where she gets her money as profits from the investment, a just normal Wyoming LLC, right? And her question's this. Is there any SEC issues with taking fees in the S Corp but holding my B shares in a separate LLC?
No, that's the way I like to do it. I like to separate the B shares where you're you're holding your asset, your 20%, your 15%, whatever, versus the management company, the sponsor, because that, again, this S Corp that your student is talking about, that's where all the liability is. Right? If anybody's going to get sued, it should be that S Corp, and you kind of almost want it to be that company. So you never want to have that company own anything, because when that company gets sued, again, you don't want it to have it has ideally an insurance policy, and you're going to have some cash. Obviously, you want to keep a couple of months or a quarter's worth of operational cash in there, but everything else should go into that company and out of that company immediately. And so you would never want to have that company also own the Class B or the LP or the GP or whatever, because that's ownership. So now if there's a lawsuit and that corporation gets sued and there's a judgment, well, now it owns 20% of this syndication, owns 20% of that syndication, and it has all these assets. And the key is to separate your liability producing activities, your operating companies, from your asset companies, your holding company. Not to mention they get taxed differently. Like the S Corp is obviously as taxed as an S Corp, it's an S Corp, and your holding companies are typically partnerships or disregarded. So they have different, S Corps are for active companies. And if your B shares are not active, then all they're doing there is holding them. So I like that. I don't like S Corps in general. Although, in fairness to your student, she, as I do, live in California, which is probably the worst asset protection state, and there's just nothing we can do about that.
Yeah.
In general, corporate, we talked about the charging order protection a few minutes ago. That does not extend to corporations. So if you have a corporation and I sue Corey and Corey has a corporation, I can get the shares of that corporation. That's why you don't want that corporation to own anything. The only state that I'm aware of, and I haven't looked at it in probably another year or so, is Nevada. Nevada does extend the charging order protection to corporations. So if I was stuck with an S Corp for whatever reason, I would probably move it to Nevada. But that's why I like LLCs. They're so flexible. You can actually have an LLC that is taxed as an S Corp. You can tax an LLC however you want. So why not have an LLC tax it as an S Corp? But look, in this particular case, just make sure the S Corp doesn't own anything and doesn't have any assets, so that when it does get sued, there's nothing to take.
Okay, that makes sense. And that really is typically, that's the structure that we utilize as well, right? We have Kahuna Management. It's managing, it's actually the one that qualifies for the loan, signs documents, right? But it owns no assets. And so I always say, like, that worst case scenario, you've got someone on the third floor of your building, they go over the rail, right? And now, someone's suing. Of course, you want, the first line of defense is always insurance. But what's after that, right? And then if they end up suing, they're suing Kahuna Management, not, my investment company that's holding profits from the deal. It's just like a shareholder. I feel like that's how we're protectors. We're just the lonely shareholders. We're not actively making the calls. Kahuna Management, even though I'm the one, me, it's the same. But the government doesn't see it that way, right?
No, I mean, let's be honest. The property LLC is going to be brought in as well because they're the owner of the asset. So if there's going to be an issue there, but again, we're talking about scenarios unrelated to the property. I'm talking about Corey. I'm picking on you, Corey, but Corey backs up on his truck and runs over the little kid on the skateboard.
Yep.
And then, so what do you own? And what I want to make sure you're owning is where the value is. I want to make sure.
So it's not really always almost the scenario you're laying down. I get it now. It's not so much what's happening at my property; it's what's happening with Corey.
That's right.
As he goes and does something. But hey, that's way more riskier too, right? Because Corey was going down the road the other day, and I rear-ended someone, a car, man. And listen, I wasn't paying attention, and someone broke their collarbone. I felt horrible.
Yeah.
I mean, it was kind of a bad accident, and it was my fault. And I had that feeling there for a minute, right? Like, oh gosh, this could get really bad.
Right.
And so it just makes that stuff could make you stay up late at night.
Right.
And lose some sleep if you're in a situation. So it really does well to plan way ahead. And sometimes I always say, you know what you know, and then a lot of times you don't know what you don't know. And there's a lot more of you don't know what you don't know out there. And so when you don't know things and you have no clue, seek legal advice, seek legal counsel. Probably the smartest things I said on this podcast since I've started.
And don't forget, if you wait until, this is a great example, if you wait until you get into the car accident and then you realize, oh crap, I need to do something, it's too late. Right, you've got to take care of things beforehand. I think I've got a couple favorite quotes. One's from Robert Kiyosaki, which says the time to put your seatbelts on is before the accident, right? So putting it on afterwards doesn't matter. And I think John F. Kennedy said something about like the time to fix your roof is when it's sunny or something like that, or when it's not raining. So you want to take care of these things before something happens, because once it happens, there are rules that prohibit you from transferring assets and changing ownership, because that'll be basically what's called a fraudulent transfer, because there's things
something coming, right?
So do it before you rear end someone.
So how did OJ get away with it?
Well, he moved to Florida, and Florida, as some other states, basically exempt your properties from being attached and your pensions. He's got an NFL pension. Well, actually, I don't think that's a Florida thing. I think pensions are really impossible to get to. So he has an NFL pension, and you can't get to the equity in your home in Florida, which is why he lives there.
Oh wow. You know, that would be like a good case study, huh?
I mean, he's got a $30-something million judgment, but they can't touch his pension. I mean, it's really hard. Even 401ks, man, it's not that easy to get a 401. IRAs are a little easier, but a 401k is tough to get. And even an IRA, you know, it's probably a percentage of it that you can get. But if you have a pension, and I'm not an expert in that field, so I don't know. I think it extends to sort of teachers' pensions. I don't think there's anything special about an NFL pension. But that's the reason that he can kind of walk around pretty freely and not worry about creditors.
Yeah, money, right? Yeah, exactly. That's crazy. All right, so a second question on to the same kind of thing. Is there any issues with separating the fee payment to an S corp? So in other words, like that management company is getting fee, like an asset management fee, right, from the B share holdings.
Well, they wouldn't get it from the B share holding. They'd be
No,
getting it from the property, from the syndicate, from the S property LLC. Yeah.
Yeah.
The S corp or the manager is providing services to the property LLC.
Yeah.
And it's managing the asset. Most of the time, you're hiring the asset manager is hiring a property manager and overseeing that. But that's a service it's providing, and in exchange for that service, it usually gets 1.5% to 2.5% asset management fee, and that's where it would go.
Yeah,
it wouldn't go to your Class B because your Class B is just your passive
profit. Yeah, exactly. Yeah.
It. So all of the activity gets paid to the asset manager.
Yeah. Cool. So I think that's just kind of clearing up the waters there. So since we're still in COVID-19, so we got to ask some questions on that issue, and then we'll wrap it up. You know, what do you see is going on in the real estate world right now with this pandemic, and what do you see going on in the activity level?
Well, obviously,
and where do you see it going?
Yeah, I mean, obviously we're just at the beginning, so that's the problem. It's a little bit of known. I mean, as we're recording this, we're actually getting unemployment numbers tomorrow, but we've already got 26 million people unemployed, which, interestingly enough, number one, is more unemployed than all the employment we gained over the last 10 years. And number two, it's about 10 times more unemployed than we had in the Great Recession. We had about 2.5 million people unemployed. So that's just a massive thing. And the real question that we don't know, which we're going to start finding out pretty soon, is a vast majority of those are going to get those jobs back, right? Once restaurants start opening back up and once the business starts going up, they're going to get rehired. But all of them, I don't think, are going to get rehired, obviously. So the question is...
And I think some people don't want to be rehired.
That's right. Some people, at least for now, don't want to get rehired.
Yeah, they're like, I'll take 6 months. Let me know when my Social Security runs out, and then I'll start looking for a job back then.
The issue now is that all these, so because we don't know, the lenders are in a tough spot because the lenders are looking at these properties and they're saying, well, I don't know what your vacancy is going to be, next month. These guys, what is the unemployment rate going to be? How are they going to be able to pay rent? What's your economic vacancy going to look like? What is the value of this property going to look like? They're just having a hard time, so until that dust settles, we're really kind of in no man's land because we just don't know. And I know that just talking to clients,
I feel the same way.
You kind of feel like, that the seller should be, reducing the price a little bit, compared to what it would be 2 or 3 months ago. But the sellers are going to hold on to those prices as long as they can. They're going to be in denial, or they're going to be dreaming that this is going to come back tomorrow.
That's why I think it's 4 months. I think 4 months, 4 months from now is when more opportunity, and probably when the markets start to, because it really is about lending. So I'm thinking about, even for myself, Mauricio, I would like to go buy a property, but I can't because there's no secure lending in the foreseeable future right now. Like CMBS loans are gone.
Yep, forget it.
Right.
And that's why it's so...
Bridge to perms are probably gone.
It's probably even more... I mean, I always recommend, as you know, we now have a real estate attorney in-house, but you want to make sure you're setting up your contracts now. If you're going to go buy a property right now, the challenge is because the lenders are so sort of in this murky area, you still have a risk that even though you clear contingencies and you're like heading to close, a day before or a week before, the lender can just change their mind. You may have a loan commitment.
Think about Freddie. They just said, hey, we want 1 year of interest reserves.
That's right. So what if you suddenly, they wanted 6 months, and then what if they now want 2 years of reserves, or what if the LTV drops? I mean, all these things, you want to have some outs in your purchase and sale agreement relating to that.
You almost have to, absolutely. And listen, sellers are going to have to agree, and they will, because they just know that's the environment, right?
And you're the best chance. And we always talk about, the leverage and everything's negotiable. You are, at this point anyway, you are the seller's best shot of closing that property. The last thing the seller wants to do, even if they're in theory able to keep your deposit, they don't want to have to put that property back in the market and go
6 months later. Yeah.
Days. They'd much rather have you close it. And so use that. If you don't have anything in the contract specifically that gives you wiggle room, that's your leverage, and just look for a win-win. Because I've seen some creative things, like on these LTVs or reserves. I've seen sellers coming in now, putting money in an escrow account for 6 months to help them cover that, while they may be able to raise them some more money in the next 6 months. But the sellers are working with them. They may not come down on price, but they may do a little seller financing, or they'll put some money in reserves. I mean, you just got to get creative.
There's just a little flexibility in the market right now.
Yeah.
And who knows where we go? It's either going to get worse, or it'll just kind of slowly come back. I don't think prices are going to nosedive yet. We still got to see what's going to happen. We're still kind of getting. It just depends on how bad are we going to go back to work? That's the question.
Do we end up with 2 million unemployed, 6 million, 4 million, 10 million? I mean, that's the big unknown, and we're not going to know that until the economy kind of reopens, and we'll get an idea of what that.
Until then, we're all suffering from bad haircuts.
Haircut.
Hey, listen, I know somebody, so I got my ears lowered the other day. And
I'm coming to your house.
It's all about who you know, Mauricio. Listen, man, I want to just thank you again for your time. Guys, if you're out there looking for a good SEC attorney, I just highly recommend Mauricio. That with asset protection. I mean, he kind of does, for his syndication clients. He really does the whole gambit for you, and it kind of sets it up on a silver platter. And I couldn't recommend him enough. So, Mauricio, if they want to go find you and your company, where do we find you at, brother?
Website, premierlawgroup.net. There's a contact sheet up there, premierlawgroup.net. Or you can just email me at mauricio@premierlawgroup.net. And also always on YouTube, man. I'm trying to put as much content as I can. So check that out.
You do produce a lot of content. I love your whiteboard and your markers.
I appreciate that.
Goes. Hey, listen. It's funny how when you go old school, I call it old school. Everybody wants to do a PowerPoint nowadays, right? But the truth is, sometimes PowerPoints are just damn boring, and really, I mean, honestly. And it's nice to have, because sometimes people don't know their content and they have to look at their PowerPoint to figure out what the hell they're talking about. But if you've got a blank white piece of paper, you got to be able to write, so your writing skills are good, or at least good enough, and that's all that matters. But again, just highly recommend my friend Mauricio. Check him out. Leave you with this, guys. In the game of real estate, there's so many things to learn and do and to understand, and the journey is the reward. Becoming a true seasoned operator doesn't happen overnight. You're going to make some mistakes along the way, but it's the journey, I think, that truly is the reward. And as you acquire knowledge and friendships and competence, and you get better at your craft, it really becomes a beautiful thing. But all that starts right in between the two ears. It starts with your mindset. You have to believe it, guys. You have to believe that the journey is worth, the juice is worth the squeeze. Real estate, by far and away, is the best thing since sliced bread for me. It's created a lifestyle that I love. I get to help people make money on their investments. I get to create wonderful communities. For me, it's a win-win-win. I think you'll find it a win too. But guys, it starts with your vision in your mind. If you believe it, you can achieve it. Your paradise is possible.